Hi everyone, and welcome to the next episode of the HeelanHub podcast, the show for small business owners. I'm Dan Heelan, and on today's show is me talking to you about whether you should be a limited company, particularly as we go into 2025. It's a prime time where people look to start limited companies, or maybe you're already a successful sole trader and you're thinking of making that leap. So it's good to recap because a lot's happened in the last year that's really going to need this topic updating. So I want to do a podcast on it, and I'm sure on the YouTube channel we'll have a new and improved video up shortly on it. Talking to YouTube, I'm actually, if you're watching this on YouTube, you'll have seen I've decided just to throw a camera on as I'm recording this and throw it up there as well, so that people who prefer to watch by YouTube, I know I'm a premium user and like to kind of listen to things on YouTube oddly, so I thought it'd be cool to have that in the background. So slightly different camera angle, and I'm not paying you complete attention, but it's there. So if you do want to watch this rather than just listen to it, it is also thrown up on YouTube for this episode. We'll see how it goes. May continue to do that. So then, let's get into it. Now, as business accountants, we've obviously helped thousands of small business owners over the years. And as a result, we see limited companies a lot. They're super popular for a lot of different reasons we're going to talk about. So in this one, I want to kind of talk about the pros and the cons, the good bits and the bad bits, and recap on those. It's a super common question. I'm seeing it pop up all the time at the moment on our social media channels and in our inboxes with people reaching out to us, just trying to find out, should I be a limited company? So I think it's worth a bit of a recap, and hopefully I can answer a lot of your questions straight off the bat there and give you some insight. Now, one of the things to bear in mind with this is that there is a load of different opinions. So we could have a group of accountants around the table and talk about, is this a good idea or not? And you have loads of different suggestions. You've probably got the same if you've got other business owner colleagues, or if you've got friends around the table. You could throw a load of different ideas, and this is just one person, and generally the us as a business, what we see. And at the end of the podcast, I'm going to give you some general scenarios where we see these things being quite good. So I'm going to talk to you through the good and the bad, and then I'll give you some scenarios where there's like a really good sweet spot that we see quite common, so you can get a feel, I suppose, for the type of businesses that might want to be limited. Now, I would say to start with, though, reminder that there's a wide variety. So we see everything from, I've got cake stalls and market stalls who are limited companies, right up to the usual kind of multi-million pound manufacturers. So it's not like you have to be a certain size to be a limited company, but there are sometimes size related reasons that mean you might make that leap. It kind of forces you into it, or it feels like it's a good idea, and we'll talk about those as well. So yeah, they're all big, they're all different sizes. So you've got freelancers and cake makers, as I say, right up to kind of big businesses. So that exists. Now, the other thing is that in this, I'm going to talk about broadly, generally, usually, and if you've listened to me or watched me talk quite frequently, I use these type of terms. And the reason being is it's so specific to your needs. And there will be other accountants watching, and you might be really clued up yourself and think, well, actually, in these circumstances, that's not true, Dan, is it? And you'd be right. So just bear in mind that this is generically, I'm talking about always with these type of things. So let's get right into the good then. So in terms of the good, what we've got is we've got a few things going on. Now, I think you can hear the paper shuffling there as well. Very, very professional of me. But in terms of the good stuff then, let's start off with legal entity. So it's its own legal thing. It's its own separate company. So you've got the limited company. It exists in law on its own. And so there's this thing referred to as limited liability. Now, that's massive, because if anything goes wrong outside of a few scenarios, in theory, it's the company's problem. There's the maximum that you could be sort of sued for is effectively whatever the company owns, the cash in its bank, its assets, the stuff it owns, things like that. And that's a really good protection. So it's very good protection if you're in, say, like a high risk area where you're worried your insurance might not pay out, or you've got a team or staff, employees, however you want to refer to them, that could claim against you. So it's very natural to see somebody want to transition to a limited company when they're either going VAT registered, or they've gone in that area where they've gone and taken a team on. And if they're there, then we see that quite frequently. And that's for exactly that reason. That limited liability is going to be really, really important for you. So that is key. Now, I say it is good, but it's not flawless. So for example, if you go to a bank and you say, please, can you lend me some money? Quite often, even if you have a really good banking history, depending on the style of loan, they might ask you for what's known as a PG, a personal guarantee. And that means they can look through the limited company at your personal assets in the case that you default. Now, if any of you were in business during the sort of the coronavirus times, you would have known that there's actually this issue where we had bounce back loans. They didn't have PGs, but that was quite rare. They didn't have these guarantees that you needed to give, but normal banking lending will do. So it's not infallible, but it is, pretty good in the majority of cases. So that's there. So limited liability being its own separate legal entity means that, you have got that protection. Now, the biggest one we see, as you'd imagine, accountants, we're interested in tax savings, and that's normally where we're talking to a lot of sole traders. If they're thinking of going limited, it can quite often be us proactively saying, do you know what, you'd actually save money as a limited company. Now, without a big history lesson, it used to be amazing. Going back, say, 10 years ago, the rates were vastly different between corporation tax and personal tax. You could arrange your affairs in such a way that you paid yourself with a very low salary and a very high dividend, which you still can do, and it's quite normal. But the difference between doing that and, say, a sole trader paying their normal tax was quite vast. And on top of that, there were VAT schemes you could do and things like that could really make massive savings. So you probably only needed to do about 16,000 maybe in profits for it actually to be useful. And I think our last video we did probably about 4 years ago on this, I think we were talking about maybe 30,000 being a good kind of amount. I think actually it's probably more like 40 plus these days. And the reason for that being is that the tax rates have changed. So corporation tax rate is somewhere between 19 and 25% depending on how much profit you make. So that's still pretty good. But then your normal personal tax rate is 20% and then it jumps to 40. But alongside this, you've also got to consider that there is national insurance. Now, the biggest change has been that self-employed people have had their national insurance reduced quite substantially. So actually, it's a lot closer than it used to be. Because recap, when you take your money out of the limited company, normally you're going to have a small amount of salary. You're normally going to pay that salary below your tax-free amount. So if you've not got any other income from anywhere else, no other job, you're going to take a salary. That's going to come out tax-free. It's also tax deductible for the company. So there's a really good sort of saving there. And you're going to pay at a level that means you're going to get a tick in the box for state pension. So all that beautiful stuff works. And then the rest of it you're going to take in dividends, which is the profit coming out of the business. Those dividends have a tax bill associated with them. And that can be relatively small or it can be quite high depending on where you are. So it starts off at the time of recording the podcast at 8.75%, and then it will jump to over 33% when you get over about 50k total income and start taking that out. So I'm trying to keep this quite top level, but that's you can see there's quite a jump there when that happens. So depending on how much you take out in 1 year, you've got to compare that to what you would pay as a sole trader. Now, you might think as well, that sounds really odd, Dan. So you've said I'm going to pay corporation tax and then I'm going to get taxed again when I take the money out. And that is absolutely true. And if you start adding some of those rates up, they sound ridiculous. You say, so I could get taxed 25% corporation tax. Then you just said 33 odd percent in dividend tax. That's like well over 50 odd percent. Yes, but it doesn't, the mathematics of it don't work like that. So in a lot of situations, it's still cheaper to the combination of those two taxes is cheaper than what you would pay over here in terms of your sole trade tax and national insurance, but it's much closer, and the situations that you need to be in to make that completely obviously better in one case or another are quite narrow now. So, and I'll touch on that near the end when I give you some examples. So, but just know that if you're earning around 40k upwards, you're probably in a good place. It will save tax at lower for sure. It's just that when we talk about some of the downsides, there's costs to take into account that you've got to have a look at. And we've just found that 40k limit, it's not even a limit, it's just a kind of a good feeling for when you look at the two combined makes more sense. So yeah, and again, it does depend on your costs, and we'll talk about that in a minute. So, but saving tax is definitely a thing. The other reason it can save tax is that the rules are different. So the rules for sole traders are really flexible, which is great, but there are certain things you can't claim, because when you have a limited company, you've also got company law to consider. You've also got employee tax law. Oddly, you as a director end up having to consider a lot of different parts. I mean, you can see behind me, if you're on YouTube or I'm pointing for the podcast, there's 22,000 pages of tax law to consider. And you're kind of in a different book with limited companies. You're looking at the sort of employee rules. And as a result, actually opens up some opportunities. So things like trivial benefits. I think we've done shows on this before. There's some tax-free benefits like mobile phones and things that you can do that are kind of limited company only. So there are other things that you can do when you're having the limited company rules in play. But it, again, depends on your situation, because just throwing out a downside, one of the downsides, let's say you're running a big diesel Land Rover, that's incredibly challenging to get a decent tax relief on in a limited company, whereas a sole trader, because the rules are so flexible, it's probably more achievable and you'll get a decent bit of tax relief on it. So a few different things going on there, but it is very kind of specific to your situation, I suppose. But just know that it's a lot closer. So if you're listening to videos and podcasts from a few years ago, or you're reading things online that look like they haven't been updated, that's probably why they sound so good. But it's just know that it's a lot closer now, but it is still definitely a thing. It will save tax in the right scenarios. Now, the other thing as well as tax, that's worth considering is knowing that alongside tax, there's also like a cash flow benefit. And this one's hard to describe on a podcast, but you have, as a sole trader, you pay tax once a year in your tax return. But if you owe over £1,000 of tax, in most cases, you're going to pay twice a year. It's known as payments on account. And you sort of pay half of you say your tax bill's £1,200, you pay another £600 at the same time as you pay the £1,200 for the year, and another £600 in the following July, sort of almost upfront for the next year. And that payment gets taken into account. So it's all fine, but it's quite a lot of cash flow. And that's small figures. £1,200 for a business that's doing okay doesn't sound a lot of money, but if that was £8,000, I've seen a few tax returns this week the team have sent out where, those payments on account can be 16,000 on their own. It's a lot of money. Now, limited companies don't have, at the small business level anyway, do not have installments. So you just pay them once a year. And that's really, really good. You as the owner, if you're taking out dividends, so quite often you'll be the director and the shareholder, so that gives you the access to the dividends. It's the shareholding element of it. You'll take your money out, and as a result, we said about dividend tax, it's really just personal tax. Most people refer to it as dividend tax. You will end up with a tax bill there that could well be over £1,000, in which case then you will pay those payments on account, but there's so much less because the big bill, the majority of the bill, is going to be that corporation tax bill that doesn't have these things on. So there's actually like a cash flow advantage often to be in a limited company. So cash flow, saving tax are both good things. Now, the other one, and I think this one's almost more common, is people see limited companies as your more established professional outfit. And there is some truth to that. I think people do get a genuine sense of kind of confidence working with a limited company. The weird kind of irony there is that we've said for legal protection reasons that because it's his own separate legal entity, it's oddly more risky, I suppose, doing business with a limited company because they can just shut the thing down and start up somewhere else tomorrow. It's not quite as easy as that, but it can have that. You can. I've just seen now, at a time recording this podcast, a couple of my clients are involved with a big customer that's just gone down and they're going to lose all their money because the company's going to liquidate and there's nothing they can do about it. Whereas had that been a sole trader, they might have been able to pursue them personally or something like that. So, but however, most people do see that limited company as kind of this bigger thing. I think the VAT registration gets looped into this as well. If you're VAT registered, people in business know that, £90,000 at the time of recording is the VAT limit. They know, or at least they can't tell whether you're turning over less than 90,000 or not if you're VAT registered because you've either hit the threshold and have had to bin, or they're never going to know. Whereas if you're not VAT registered and you're not supplying something like insurance or something that couldn't be VAT registered, they're going to know that you're a relatively small business, and that can cause you problems in some circumstances. Not in a lot, but I've seen it over the years where people have taken advantage of the small business status. So there we go. I think for a lot of people, the limited company does look bigger and better. Now, on top of that, I think sometimes you're forced into it with a limited company. We used to see this years ago with freelance contractors had to be limited companies. People were worried about something known as IR35. There's a great book behind me, and I used to spend a lot of the sort of 2010 onwards talking about IR35 and how it might affect you and how it might not. I'm not going to go too deep into this podcast because it's not that relevant, but just know that for commercial reasons, you used to have a limited company in some circumstances. People wouldn't work with you. It's a lot less now. I very rarely see that, but sometimes I know people doing Amazon businesses and things like that feels like that, like they need to get a limited company because of some VAT problems and some of the questions they're being asked. So sometimes commercially, you might actually be forced into it. I don't know if that's really a pro or a con, but it's just a note really to put into the middle. Now, just finishing up really on the good stuff, one of the things I didn't talk about when we talk about tax is this idea of some control over when you're taxed. So if you imagine as a sole trader, your income's almost snapshotted. And what I mean by that is you add up, there's two ways of doing it actually without going too deep into it. You can either add up all of the money that you had in and all of the tax deductible money you had out and pay your tax bill on that. But either way, that's defined, isn't it? In and out, that's what you're paying, tax bill's calculated. Or you can do it on dates. They call it the accruals method or kind of the standard method. Us accountants like that, but these days it's not as common with the sole trader. And what you do is you work out, even if you haven't raised the invoice yet, if you've done some of the work in that tax year, you're going to work all that out. If you paid an insurance bill near the end of your tax year, you're only going to account for the months that actually come into that tax year. Like you get a real true accounting profit. And that method is obviously great. You get a proper true profit from figures. So if we're doing that, we're normally doing accounts with it and things like that. Now, either way, you're in no control really about what you've done there. The cash one can be some control because you can choose to pay something in advance or not to be paid the money, and you can control to a degree. But either way, that's it. Whatever money you made in that year, you're going to have a tax bill on. Now, with the corporation tax, that's the same. It's no different. It's actually you have to do the complicated version of timing everything into the year in question. So you have to do this accruals method. And as a result, that's quite good from a business owner point of view that wants to grow their business because you can see the figures and the figures mean something. But that is kind of snapshotted. That's your tax bill. But where you make a big impact is you're then in command of the second sort of tax bill we said about you drawing the money out as the owner. You don't have to draw the money out, hopefully, or you might want to do other clever things with it, like pay it into a pension or some other things that can really help it from a tax point of view. Those things aren't often in your control as a sole trader. Some are, but some of the specific things I'm thinking about at the moment aren't. So you have a lot more control as a limited company of the overall tax liability, presuming you don't just want to grab every penny from the limited company, because if you do want to grab every penny, you're going to be back to this similar result. And I think we see a lot of owners who, if they're in that place, sometimes a sole trader, even if it will save tax, becomes easier to manage for them. So just know, that's quite a key indicator when we come to the end of talking about it, is if you feel like you need every penny from that limited company, then the sole trader starts to swing back to being a bit more effective potentially for you. So from a tax saving point of view, if you can be in control of it, you can start to really move that gap between sole trader and limited in a really positive way. So there we go. So there's some of the good ones. Oh, and finally, one more that I nearly forgot. If you're looking for investment, so because there's shares, official shares, they're a thing. Someone can buy a chunk of your business in a percentage. For investors, that's really clean. So taking on partners or investment or raising funds or whatever you want to call it for equity, as it's often known, the limited company is always going to be the thing that people do. It's very rare you get a personal investment. I have seen it before. And the only time I've ever seen it, it got really quite nasty later down the line. So generally, if people are looking to have loans or investment, unless it's from a parent for a small amount, they normally end up with a limited company. So there's some good stuff. And for all those reasons, as I said to you, as small business accountants, the majority of our clients are going to be limited companies. Now, the bad then, the cost. Let's talk about cost. So the cost from a limited company, there's a small cost to forming it, and there's a small cost of filing a company's house return each year. But the main cost is in accountancy fees. Currently there is free software to do this, but in June 26-ish is disappearing, and the free software that's out there now is very, very strict in terms of whether you can actually use it in your circumstances. But there is one there, but probably 90% of limited companies, I don't know the exact stats, I'm making this up. I did have them actually at one point. I did manage to speak to Companies House who gave me some stats on this, but they're not to hand. But let's just say the vast majority of limited companies will have an accountant to file them. And the main reason being is that you've got a lot to do. You've got a set of annual accounts that need filing with Companies House. You've also got to do these timed accountancy rules that define how they're set up, set of accounts that have to actually get submitted to the tax office. You don't have that with the personal self-assessment tax return. That personal return is free software. In actual fact, if it's a small tax return, you might only be filling in 3 boxes on it, and that's the dates, how much you had in and how much you went out for tax reasons. This is in terms of your business, your sole trader, and that's kind of it. The skill in there is obviously making sure that the things that are in the boxes are the right things, and most of the things you can claim, and reducing that tax bill where possible, and using other allowances that might be available to you as a whole as a taxable person. So there's a lot more that goes into it, but from a practical sense, that's kind of it. It's fairly straightforward. Limited company is not the case. And it doesn't matter whether you've done £500 to take the cake stall type client. I remember vividly a cake stall that did £500. Our fee was more than double that to file the accounts and shut it down. And the owner wanted to do it because they just thought it was a good idea, and it only cost them peanuts to set up a Companies House, and there was no real need to do it. But the problem is the paperwork required for £500 is almost the same. Well, it is the same as it is for £85,000, just as an example, or £90,000. You've got to do a full set of accounts. You tend to do a cut down set of accounts for Companies House. They go to 2 different people, and you've got a corporation tax return, which those accounts have got to be electronically tagged in a certain format, which again is where the software piece comes in. And for us accountants, we all pay for commercial software to do this. And all that gets tagged, put in, you've got to have conversations and get everything as tax efficient as it can to be submitted. So there's just a lot of cost. It doesn't matter what you've done. And I think people often say, yeah, but my thing's really easy. And it's like, I understand you might think it's easy, but the paperwork isn't, hence why us accountants exist. So no, that's probably the biggest con or biggest bad sort of thing for limited companies is this cost. So if you're thinking of a startup and you're really not sure, then please do consider whether it's a good idea to need the limited company from day one, or whether you could potentially set up as a sole trader and then make the move. And I think that's absolutely something that we suggest to people all the time is if you're really not sure, well, just go be a sole trader and move to it later because it's going to be cheaper. Particularly if you've been on one of these courses where they're like, you need a holding company and you need this structure and everything else. You're talking accountancy fees for every one of those companies. And if you don't need it, don't set it up, add it later. There's lots of ways. Obviously, if you don't know that if that's right for you or not, seek professional advice. There'll be somebody who will be able to help you out with that. But just think every company you have is going to need accountancy fees. So just bear the cost in mind. That's the absolute worst thing. And the amount of work required means that you can't leave it to the last minute either. So we see a lot of people with who will contact the business and say, I've got a set of accounts due in 4 days' time. We just couldn't do it. Or we could, but it would cost you far more money than you wanted to pay. Well, I'll get somebody to work through the night or something to get it done, because it's quite a hefty piece of work to file these things and produce them all. And as professionals, we have to document everything we do. And yeah, it's just a long process. So bear that in mind. Give yourself loads of time and make sure you look out in advance of what it's going to cost you. And we could do an entire podcast on the differences in terms of what accountancy fees might look like and what you could expect for your money. But you'd be struggling to get anything less than probably £650 a year to get something filed plus VAT. So there are offshore ways of doing it, but generally you've got to think about that. I mean, most of the time I think you're looking at least £1,000 to do these kind of things. So just bear it in mind when you start the company. It's just the cost of doing business, and if it's going to save you tax and it's going to do all the wonderful things we said in the good section, it's well worth it. But we see so many people that just start up and don't do anything with it, or did 50 quid in it or something like that. So just bear that in mind. Now, the other downside I would say is that you need more strict bookkeeping. So with a sole trader, we already said that really you're looking for almost an in and an out. We want to know what come in and what went out for tax purposes, and that's about it. From a limited company, every single penny in that company needs to be accounted for in some way. And you need better bookkeeping. And I would almost go as far as to say you need software. So a Xero or a QuickBooks or something like that would really, really help with this. And you can connect your bank and you can kind of categorize everything. It's a really good collaboration tool to work with accountants. And us as a business, we very rarely take clients on now that aren't in these things, because it makes it very difficult for everybody involved. And that sounds odd because you think, well, it can't be that complicated, but it's you need to be able to produce 2 documents, something known as a profit and loss and a balance sheet or statement of financial position. And those 2 things are produced by the software, at least in a draft format. Accountants need to go in and do all the timing differences and fix everything, but it'll give you a draft format. A general spreadsheet, or some of these ones you see with your bank where they're like, use our software, is really just almost a categorization tool, and that's not good enough. Again, it's probably for another podcast, but just know that the detailed bookkeeping requirements are different. And if you are looking to get a Xero license, we do have a special code for you. Actually, you don't need to be a client. If you just go to heelanassociates.co.uk/Xero, there's a deal on there if you can get it super cheap for 6 months. So if you are thinking of taking a Xero license, go and do that. So when you've got that sorted, so when you're thinking about these limited companies, think about the cost involved further down the line, and think about, okay, I've got to also make sure that I'm keeping good records, and probably need some sort of software. And again, there's cost related to software. So there's a couple of things there to think about in terms of, I suppose, the bad side of it. Now, just following up from that, I think there's a couple of other things that are worth mentioning on the bad version. And that is the fact that, one, you've got your information in the public domain, so that people will know, and it's easily searchable. They can search for you in Companies House, they can see your company, they can see limited financial information about the company as well. Now, I say limited because there's current plans in June 26th for this all to change, and your entire profit and loss, so how much money you make, what you turned over, and all the rest of it, is due to be exposed on Companies House. Me personally, I've been fighting this for a while and will continue to do so. I think it's really bad for small business, but know that in theory that's coming. At the moment, there's limited information, so some people can still see roughly, a bit of information about how you're getting on as a business and not, and things like that are online. So you might not like that idea, but unfortunately, that is the price of a limited liability at the moment, is that some of your information is in the public domain and searchable. So I'd say that's quite a big downside if you're worried about that kind of stuff. And then the other one is if you did decide to close it down. I spoke to you about the cake lady a few times during this. The cake lady, we needed to shut her business down because there was no point in her having it. She should have been better off as a sole trader. And there was something called a trading allowance that she could have used that make this all far more cheaper and pay no tax on any of it. Now, there is hoops you've got to go through, and there's a process to shutting companies down. So they're not as easy as a sole trader. Quite often with a sole trader, you're just putting a date in a box on the tax return, and that's kind of it. Whereas a limited company, you've got to do several things and strike it off. And surprise, surprise, there's a fee to pay at Companies House when you submit the form that's just gone up to over £40. So, and that's on top of any assistance you need to kind of do the forms to shut it down. So just bear in mind, they're slightly harder to shut down than it is with the sole trader. So then I did say to you, let's talk about a few situations there when we see it being most useful, most common. So I think right now with a limited company, I think the general strategy for most businesses will be, if you're really not sure, just go sole trader. You can always incorporate later. For some, for commercial reasons, we've said that might not be an option for you. You might feel like you have to, and in which case you just got to back yourself hard and make sure you make the required money to pay for the things you're going to need to pay for, right? That's just going to be part and parcel of it. I'm sure there's other stuff you've got to commit to at the same time. So it's just making sure that you've considered the cash flow of it, make sure you've got enough money to keep the business going for a while. We've done loads of shows on this, and I'm sure we'll have another one in terms of talking about it always takes longer than you think to generate the money that you'd hoped. So make sure you've got a bit of a runway in cash. But that aside, if you do need a limited company, there's a couple of things where we see they're a good fit. So if you're earning over about 40k, quite often the tax savings is going to be worth it versus the cost of paying it and the cash flow on these payments on accounts we spoke about. If you've got other income and you don't need the money, or you're looking to put that money into a pension, that's a really common scenario. So we've got a lot of people who might say do 15 grand profit, doing a bit of freelancing, and they've got a main job where they're earning 40 odd grand, and it makes complete sense because with that money they either want to invest in property or they want to put it in their pension. And as a vehicle, the limited company is quite good for all that kind of stuff. So that's really good. And as I said, generically, if you want to put money in a pension, they're quite good for kind of funneling that money through, paying a cheaper tax rate depending, and working out quite well. If you've got a significant other that wants to be part of the business, so generically, husband and wife scenario where you're both kind of in the business, you can split your shareholding, you can split some money so your profits come out equally or not even equally. There's a special shareholding way of doing it where you can split some of it between you. That can save a lot of money, particularly if there's child benefit involved, where you might lose child benefit, but you could arrange your affairs between you so that none of you exceeded the limit for repaying your child benefit. That can be quite big as well. So in those kind of scenarios, it's very, very common. So if you've got other income and you don't need all the money, that's a very common scenario of having it. If it's your main deal and you're earning over 40k a year, that's normally quite a good one for tax purposes. And they're just, again, they're not exact sciences. They're just a good idea of some of the scenarios where we've done the mathematics of it and seen that actually, they're where we know that they work really, really well. But ultimately, like everything, seek professional advice to get your scenario looked at as to whether it's a good idea. Go seek out an accountant. Obviously, if you want to get in touch with my team, you know where we are. But go find some information and get a bit of a consult on these things and just figure out if it's right for you. And that is probably it in terms of a bit of a recap and a summary. So as I say, a lot's changed over the last kind of year with the national insurance coming down, the potential to have this public information displayed in the coming years. They're two big things. So just keep an eye on it. And if you're listening to this, I don't know, in the next 6 months, maybe it's worth checking out in case any updated versions have been done, because you never know, we might have a budget in March that changes it or does something. But at the moment, there's a corporate tax roadmap out by the Labour government that suggests that things aren't changing in the corporate world. So I'm hopeful that we've got a bit of stability and we can make some plans around it, because we've just had a big change to employers' national insurance that definitely does affect sole directors in a lot of cases and makes them even more slightly worse off than they were. Still good, so it's still good, but again, there's an added cost there as they continually sort of bring this gap together. So hopefully you've enjoyed the show. If you have, please do share it with anybody you think needs to know this information. If you can, make sure to subscribe via your favourite app. I know a lot of you, the vast majority of you, pick it up on Spotify, so make sure to subscribe on there wherever you can. If you do have a few minutes, I'd love it if you left a review. That'd be awesome. If you're watching on YouTube, if you don't mind bunging some comments about how you found the show. It's one of the challenges, I think, of podcast format is we don't kind of have the interaction that we often do on YouTube, although actually there's been a lot more people these days emailing in, which is really nice to see. So if you have enjoyed it, please do let us know. It's nice to kind of read. And if you do want to see any particular topic on the show, just let us know. For more business insight and tax tips, be sure to connect with me and my great team on all the social media channels, including, of course, YouTube, TikTok, LinkedIn, Twitter, Facebook, pretty much anything. We're on Instagram. We do a lot of talking in DMs there. So on all those different channels. You can also sign up to our HeelanHub Herald, which is a 2-weekly email direct to your inbox. And you can do that at heelanassociates.co.uk. Move around the site long enough and you get a pop-up that will prompt you to put your email address in, and that will come straight to you. If you do want to get in touch about the podcast directly or anything else, you can reach out to us at info@heelanassociates.co.uk. That's it. Have a profitable and tax efficient week, and I'll see you in the next one.